This is a presentation of Ramsey's Capital. Hi, I'm Mark from Ramsey's Capital. If you've been watching my videos, you know me already. I'm principal of Ramsey's and also director of acquisitions. So what I wanted to talk about today is something that people who are getting involved in investing in multifamily properties really need to know. And some of the people that I've talked to who are thinking of investing ask questions about, how do you come up with the value of the property? And when you're talking about value add, what makes you think you can increase the value of that property over a period of time? So what you have to understand is when we're talking about multifamily complexes, and particularly the larger ones, you're looking at multifamily generally that's 5 units and much more. So let's talk about that for a minute. The way you value properties that are multifamily properties of larger sizes is not the same way you value residential properties. In residential properties, you go out and they do an appraisal looking at the sales in the area of other similar houses to come up with a price. And then, of course, people can overbid or underbid on that price, but you're in the general ballpark there. With multifamily, it's different. There's something called a cap rate, and different areas have different cap rates. So based on the particular area, you would look at what the area cap rate is, and then the value would then be based on looking at the net operating income of that building and the cap rate in the area. So as an example, and I'm simplifying this a little bit, as an example, let's take an area that has a 10 cap, and we go in to buy property in a 10 cap area, and let's say the current owners are at a net operating income of $100,000, and I won't go into what's included in the net operating income right now, but I will tell you it does not include the mortgage, okay? It's just operating expenses. So we go in and this property is operating at a 10 cap, and a 10 cap is really what we're saying is you could get as an investment on this property, whatever you're investing, you're looking for a 10% return because it's in a 10 cap area. So if we said it was a 5 cap, you're looking at a 5% return in this area based on the price you would pay for that building. So let's look at a 10 cap to make calculations easy. So we go in, we see the property is operating at $100,000 net operating income. We would look at that and say, okay, if we're looking at this as a 10% return on our investment, we would divide the 100,000 by the 10% to come up with $1 million. So that building theoretically is worth $1 million. So let's say we're putting a package together and we say there's value add here. So the value add here might be we see ways of reducing our expenses. We see ways of putting value into the building where we can increase rents. So the bottom line will be an increase in our net operating income. So let's say we do that over a 5-year period. We now have, and we could do it in a number of ways, but now let's say we've raised the rents, we've decreased expenses. Now our net operating income is $200,000, and we're going to still look at this as a 10 cap area. So we've added value to that building by what we call forced appreciation. We've improved the operation. So the $200,000 net operating income now divided by 10% is saying in this 10 cap area, that building could now sell for $2 million. So as an investor, You went in on that at $1 million. You did a lot of nice property management on it. You increased your net operating income. It's still a 10 cap area, but now in 5 years you go to sell it, you're going to sell it for $2 million. So that's basically what we're talking about, and that's what savvy real estate investors are looking for when they're either syndicating or they're coming in as a passive investor. So you may get cash flow during the building operation while you hold it, which is always great. And you may be an investor that's looking for a certain return on your money during the normal cash flow years. But that forced appreciation at the back end when you sell or refinance increases the value tremendously if you do it the right way. And therefore, when you are selling out of that multifamily property, you now are making money on the back end through the appreciation. So basically, I hope that helps people understand what I'm talking about. And multifamily values are based on cap rate and net operating income that you can produce. So thanks, guys. Thanks for listening. And we will be back here and talk to you again soon.